So today I'd like to give a quick introduction to CT Private Equity Trust, including our investment approach, returns to date, the composition of the fund, a couple of investment examples, and then open up for Q&A. So CT Private Equity Trust is a £500 million investment trust. And as the name suggests, it's invested into private or unlisted companies. The trust itself is listed on the London Stock Exchange under ticker CPET, and it's therefore available for anyone to buy, providing easy, low cost and liquid access to the private equity asset class. In March last year, the trust celebrated its 25th anniversary. And on the slide, you can see a picture of us marking that milestone by ringing the closing bell of the London Stock Exchange. Now, whilst people have always invested in private companies, the modern private equity industry really dates back to the 1980s and the development of the leveraged buyout. Since then, the industry has grown very rapidly, and it's now forecast to reach $20 trillion by 2027. Now, that growth is due to three key advantages. Firstly, the opportunity set. There is a huge number of high growth private companies to invest in. So to put that in perspective, within Europe, there are now more than twice as many private equity backed companies as public companies. In addition, there's a huge untapped pool of companies for private equity to invest into. For example, it's estimated in in Europe and the US, there are over 400,000 companies with revenues of over 10 million. Now that compares to just 11,000 public companies, a number that's been declining in recent years as companies increasingly choose to stay private for longer and indeed in many cases to delist. But it's not just the number of companies, it's also the type. Private equity provides exposure to high growth, innovative companies in new markets and sectors often not available to listed markets. Second is the approach, which is long-term and active. The typical targeted holding period for private equity is 3 to 5 years, sometimes much longer. And private equity brings both financial capital, but also human capital. And that is targeted to portfolio companies to accelerate growth and value creation. And when it's done well, private equity is a true partnership. And thirdly, strong returns, significantly outperforming public markets, whilst also providing a diversification benefit. Now, private equity is often seen as the preserve of large institutional investors, something not available to the average man on the street. This is, however, changing, and we're keen to ensure that everyone has access to the superior returns provided by private equity. And we believe the trust provides an ideal and simple way for investors of all types to access a well-diversified portfolio of high-growth private companies. Now, the trust targets long-term capital growth and income for investors by investing in high-growth, profitable, small and mid-sized companies in attractive markets with entrepreneurial management teams. These investments are sourced from our network of over 100 mid-market, regional and sector specialist private equity managers, a network that has been built up over the last 25 years. The trust is broadly invested 50% directly into companies and 50% into funds. And that provides great diversification and a portfolio of about 500 companies. Geographically, the split is approximately 40% into the UK, 40% into continental Europe, and 20% into the US. So on this slide, you can see the 25-year performance of the trust, both NAV performance and share price performance versus the FTSE All Share, the dotted blue line at the bottom. And that just shows the very strong outperformance that is available through private equity. And then just for a bit of fun, we've included in there as well Berkshire Hathaway, the grey dotted line. And that's because AJ Bell did a nice little bit of research last year. They looked at the approximately 1,000 funds available to UK retail investors. And of those funds, only 41, so less than 5%, had outperformed Warren Buffett over 20 years. And when they looked at those 41, there were 8 with the same management team over that 20 years. And I'm very proud to say that CT Private Equity Trust was 4th on that list. So that's obviously great news. Also interesting as well is of those 8, there were 2 private equity trusts. And I think that speaks very strongly of the opportunity and the outperformance that's available here. So the trust pays a quarterly dividend with an annual return of 4% of NAV. And as you can see on the slide, this has resulted in very predictable and rising dividend over the years, and an attractive dividend yield, which currently sits at about 6%. This is something that both the board and the manager are very committed to. And that dividend has risen every year for over 10 years. And as a result, the company is recognized by the Association of Investment Companies as a next generation dividend hero. So whilst you heard from the last speaker, listed markets are becoming increasingly concentrated in a few very large companies. Meanwhile, we believe that diversification is absolutely critical to mitigating risk while maintaining strong upside potential. The portfolio is therefore well diversified by sector, by geography, by year of investment, and by lead manager. Investments, as I mentioned, are typically made with a 3 to 5 year holding period, and the portfolio is continuously refreshed by investment, growth and value creation, and divestment. On this slide, you can see the top 10 underlying holdings of the trust, which account for just under 22% of portfolio value. A good mix of companies in different geographies and sectors with no single company dependence. And I think it's worth pausing on the diversity of the companies here, from OHI, the leading helicopter provider in Latin America, to Cyberhawk, an innovator in drone services. From Sanzero, a funeral service operator, to Weirdfish, a casual clothing brand in the UK. A real mix. That said, the portfolio has been constructed with a consistent strategy since inception. We're looking for companies with leading positions in attractive markets, with differentiated and proven products and high barriers to entry, entrepreneurial management, high margins, strong cash generation, and a proven track record of financial growth, backed by experienced private equity executives at attractive valuations. Growth is then accelerated and value created through a number of repeatable strategies. And those include investment to accelerate growth, strategic M&A to consolidate markets, add capabilities, and enter new markets, refining commercial strategies, strengthening management teams, geographic expansion, digital enhancement, and improving ESG practices. In terms of size, we consistently focus on smaller, higher return deals. We invest in the mid-market, and we define that as companies with an entry value of up to 500 million. And within that, our real focus is the lower mid-market, companies with a valuation of 30 to 150 million. This represents a huge investment universe of high growth entrepreneurial companies with very low penetration by private equity. It's much less competitive and intermediated than larger markets. It favors regional and sector specialists with whom we're partnered, benefits from reasonable valuations, and returns are driven by revenue and earnings growth, not by financial engineering. We invest in these companies through three complementary investment types. Firstly, funds, where we're backing proven and up-and-coming managers. This helps to build strong relationships with those managers, provides a steady cadence of investment and divestment, and a flow of secondary and co-investment deals. Secondly, secondary investments, where we acquire the holdings from other private equity investors. These tend to be more opportunistic and are often acquired at a substantial discount from forced sellers. And thirdly, co-investments. So investing directly into companies alongside lead managers, providing direct exposure to the very best companies. So let's take a look at a couple of examples. So a recent fund investment is Inflection Enterprise Fund 6. So this is a £975 million fund that is targeting lower mid-market investments in the UK and Western Europe. It's managed by Inflection, who are a key investment partner of ours and with whom we've been investing for more than 20 years. And I would argue they're probably the leading mid-market manager in the UK. Inflection's got a very large and well-resourced team that can help portfolios refine business models, accelerate growth, enter new markets, and complete add-ons. A recent co-investment is Accounts IQ. This is an Irish software company headquartered in Dublin. It was founded in 2005 and it aims to provide modern cloud-based accountancy software to mid-sized companies. Now, we were attracted to this because of the market, which is large, resilient, and growing very well. And we could see that Accounts IQ have a very well differentiated product with modern software architecture, but also addressing an underserved part of the market. Those mid-sized companies are not currently well served by the the mass market products for smaller companies, nor by the very large, complex enterprise solutions. It's got a well-proven track record of growth and very strong financial metrics, as you can see on the slide. That was a deal led by Axiom, a new or emerging manager focused on lower mid-market technology investments. So Jollyes is a UK large format pet retailer, and until recently it was one of the top 10 holdings in the trust. We invested in Jollyes back in May 2018 alongside Kester Capital. At the time, Jollyes was a family-owned business, and it was the number 2 pet store in the UK behind the much larger Pets at Home. We were attracted to the business because of the large and resilient market, which is growing rapidly, driven by increasing pet ownership, but also increasing spend per pet. And that's really driven by a trend that's often referred to as the humanization of pets. We could also see a very clear plan to strengthen management, professionalize the business, and accelerate growth. And over the holding period, those improvements were successfully implemented. A new store rollout plan was executed, growing stores from 60 at investment to 100 at exit. And Jollyes was transformed into one of the fastest growing physical retailers in the UK. And in March last year, the business was sold to TDR Capital, a larger private equity firm, returning an excellent 4.2 times cost and 27% IRR. Another recent exit and another top 10 holding is ATEC. So ATEC is a specialist insurance broker for assets like caravans, boats, and beach huts. We're attracted to this company because it's a leader in its niche, and it had a very strong technology platform, which we believed gave it a real sustainable advantage. Over the investment period, the team was strengthened, the product range expanded, and profits grew from 2.4 million at entry to nearly 10 million at exit. And the business was sold last year, again to private equity, returning well over 4 times cost. The full return is unfortunately not disclosable. So going into 2025, there remains considerable geopolitical risk. However, we remain cautiously optimistic and anticipate a continued recovery of private equity markets. The trust has a well-diversified portfolio which remains resilient. Much of it is invested in long-term growth sectors such as B2B software and healthcare. The trust has a strong balance sheet. We're seeing an excellent flow of new potential investments at reasonable valuations. We continue to see exits from the portfolio at a substantial premium to holding value. And we can see the number of exits continuing to build, with exits year to date to September up 74% on the prior year. So with that, we remain confident that the trust will continue to build shareholder value, both over the short and longer term. And with that, Jeremy, I'm happy to hand back to you and answer any questions.
Well, we certainly got some questions coming in. One of the notes I was writing down was while you were talking was this idea that you've got this split. There's 50% in direct companies and 50% into funds. This is picked up by one of the questions that's come in. What could change that? Do you think that that's something which is movable? Do you try and stick that 50-50 to give you the spread? Or is this something that could change over time depending on the outlook and the available investment opportunities?
Sure. So co-investments, investing directly into those companies alongside leading managers, has been something we've done for a long time. Really, the track record dates back to 2003, and we've made well over 100 of those investments to date. We see it as a really core piece of the strategy. And over time, we've increased the level of co-investment. So just recently, we went to shareholders and increased the level that we could make into co-investments. I think now we're at the right sort of level. 50-50, I think, is a very good balance between the directs and the funds.
Yeah. Aligned to this, I guess, is partly this thing about churn and how often private equity fund likes to move things around a little bit. You gave us indication of the sort of companies you're investing in, and it's interesting to look at that list because it gives an updated idea about what's hot at the moment. What do you say about the opportunities here? Do you see companies coming in and out very often? I think this is related to a question which comes in about valuations. How are the companies you invest in valued, and how often are they valued, and how much of an impact does this have on churn?
Okay. So in terms of the valuation point, because that's probably the easier one to pick up, the companies are valued quarterly. And then that goes into our quarterly NAVs that are published. In terms of the churn of the companies, as I mentioned, typically private equity targets a 3 to 5 year hold. It's fair to say, though, in recent years, the average has crept up a bit. So I think the average is now sort of closer to 6 years. And that just reflects some of the problems we've had in the wider economy. But it also represents an opportunity in that there are obviously some older companies in the trust, which I think are really ripe for exit. And as exits are typically at a sort of 30% premium to holding value, when we have those exits, it tends to really boost the NAV performance of the trust.
Yeah. When we're talking to Richard Hickman, he was talking about 2025 potentially being a really good year. I don't know whether or not you share this. It'd be interesting to get your views on this year. And one of the questions really is about this, and talks a little bit more about which sectors do you favour for investment this year?
Yeah, so I'm pretty optimistic for 2025. I just caveat there's still quite a lot of political risk around. But I think one of the biggest challenges for the private equity sector has been the number of realizations. And I think we're beginning to see that recover. I think it should continue to recover. We've seen interest rates begin to come down. I'm not expecting them to come down rapidly, but I think we've seen the peaks, hopefully. We've also seen debt costs come down as traditional banks have really re-entered the market, which for a while have been very much dominated by private credit. But really, it comes down to investor confidence. And I think that's beginning to build. Last year was a year of elections all around the world. Those are now behind us. And as long as we don't have any big risk event, I think investor confidence will begin to build and we'll see the activity pick up.
It's interesting, isn't it, when looking at, as you say, consumer confidence and what's been happening politically since the elections last year. I noticed actually this morning there've been some breaking news coming through, Prime Minister speaking at an event, and he now wants to hardwire growth into all the decisions of the cabinet. Now, we know that there are some incoming policies over employers' rights and net zero, which I know is being a massive headwind to investments here in the UK. Steering around the political side of it, because I want to avoid that, but looking at how this lays out across the sector we're talking about this year, clearly there's a shift in some of the appetite to try and get growth back into this market. How much of an opportunity do you think there is here now, bearing in mind the UK has been one of the underperforming markets of the world?
Yeah, I think there's huge opportunity in the UK, and you can see that by the fact when you look at our portfolio, we are overweight the UK versus our competitors. And I think it's worth drawing a big distinction between UK private company performance and that of the listed markets. The UK is fantastic at innovating new companies in a number of growth sectors. What we're maybe not quite so good at is keeping hold of those companies and growing them to the size of the technology companies you see in the US. Unfortunately for the UK, they tend to get sold earlier, but that doesn't necessarily hit our returns. We're investing in those much smaller companies. We don't tend to be dependent upon IPOs. That's not our typical exit route. We are typically selling our companies either to larger companies, what we call trade acquirers, or to larger private equity funds.
To what degree have you answered this next question? What catalyst can you foresee that might reduce your share price discount? There's always a push to try and improve valuations. Anything else you want to incorporate in that sort of answer about how you see things in terms of catalysts which could help this year?
Yeah, I think the discounts of the private equity sector tend to move with investor confidence. When the market is risk on, the discounts come very narrow. When the market is more wary, the discounts widen. So I think sentiment will be a big driver, but I think the more specific drivers will be an increase in realizations and an increase in NAV performance. I think if we see those come through, we should see the discount come in.